Hey everybody, I'm Mike DeSepoli and this is episode 50 of the Ask the Advisor show. Well, the Senate finally passed tax reform over the weekend and we want to talk about how it affects you. I'm a little bit under the weather right now, so please forgive me for a lack of a voice, but the details are too important to delay in getting them out to you. So let's look through some of the changes. Now, the first thing you need to understand is the Senate and the House have their own versions of the tax bill right now, and there's some differences between the two. Obviously, they will work together in the coming weeks to try to mold those two bills into one and get some legislation to the president's desk. What they hope is before year end so he could sign it and put it into play for next year. So, what deductions can you claim under the Senate bill just passed? Well, there's a lot of limits to state and local income tax deductions, property tax deductions, and whatnot. So let's look first at property taxes. Property tax deductions will be capped at $10,000. Most areas in the country, that may be a non-event for them. Now, obviously here in the Northeast, our property taxes tend to be very high, many homes above $10,000. So that's something that will hurt us a little bit if they're capping our property tax deductions, but we're hoping that we'll make it up in other areas to come, as we'll discuss here. What about personal deductions? Well, the personal deductions and married filing joint deductions are being increased, so that'll be a win for taxpayers. For a single individual, the current personal deduction is $6,350. That's going to be increased to $12,000, nearly doubled. For married couples filing jointly, the current standard deduction is $12,000. That will be increased to $24,000. So they're doubling that standard deduction, which basically means for a family married filing jointly, the first $24,000 that they earn will be tax-free. What other deductions can we talk about? There's been a lot of debate about mortgage interest deductions, and currently this is one place the House and the Senate have different opinions. In the current Senate bill, they still allow mortgage interest deductions on loan values up to $1 million, which is currently how the law is written in present day. In the House bill that they're proposing, they want to cap mortgage interest deductions at loan values of $500,000. Obviously a big difference there. In the House bill, that would mean if someone has a loan balance of $550,000 on their mortgage, they would only be able to deduct the interest on the first $500,000 of the loan value, and the remaining $50,000 would be a non-deductible interest payment. So obviously we'll see where they hammer that out. I prefer the $1 million threshold better, which would keep the housing market moving, keep buyers buying and sellers selling, but we will see how that comes to shake out in the next couple of weeks. Will the brackets change at all? Well, currently the House plan has 4 brackets. The Senate plan has 7 brackets. Either way, regardless of the number of brackets, they both aim to lower the taxable bracket that you would fall in. So we'll see where the number of brackets ends up at the end, but the number of brackets is not as important as the rates that you pay per bracket. So we're looking to see decreases across the board, and both plans currently have that. Now, you own a small business. What would that mean for you? Well, the Senate bill allows owners of so-called pass-through businesses like S corporations to deduct 23% of their earnings and then pay the rest of their taxes at their personal income tax rate. So hopefully that will be a tax savings for most people as people pass through their income through their S corporation to their personal tax return, and hopefully the income tax rate that they're paying on their personal will be lower than what they're previously used to in the years ahead. Obviously, there's still a lot of horse trading that's going to go on between Congress, in the House, in the Senate to get a final bill to the president's desk. But what can we expect moving forward? When should we expect this bill both to be signed and to take effect? Well, it'll have no effect on your 2017 taxes. This will not be a retroactive bill that will revert back to the start of the year and give you those benefits. If they are able to pass this bill in the timeline that they've outlined, which is late December, it is something we should see in place for January 1st, 2018 and moving forward. Is there any action that you should take between now and the end of the year? We'd encourage you to talk to your accountant, your financial advisors, and talk with them about the changes in the new tax law, how it will impact capital gains, capital losses, and business revenues that may come about in future years. We hope this is helpful, guys. If you have any questions, feel free to reach out to us. How this pertains to you or your small business, we'd be happy to talk with you. And share this video with somebody who owns a small business and is not sure how the new tax landscape is going to look for them. Thanks for tuning in, guys. 50 episodes. It's really hard to believe. We'll see you back for episode 51.